A very warm welcome to all our viewers and wishing everyone a very happy Diwali on behalf of Cedrus Wealth Partners. This is our 23rd edition of the Cedrus Knowledge Series, an initiative wherein we have one speaker each month speaking on a variety of topics ranging right from investing to well-being. We'll now play a short video of Cedrus Wealth Partners. For our 23rd edition, we're extremely pleased to have with us Mr. Maran Govindasamy, co-founder and executive director at Unifi Capital. We'll now play a short video to further introduce him. It's an absolute pleasure to have you with us today, sir. And we all are looking forward to your views on the mid and small cap investment strategies. Once again, a very warm welcome, sir, and to all our viewers. I would now like to hand it over to Mr. Nilesh Bajaj to take the discussion forward.
Happy Diwali to all our viewers, and Mr. Maran, very happy Diwali, and thank you for being a part of the 23rd edition of Cedrus Knowledge Series. And what better time to call you than the Diwali season itself, the Samvat 2079, whereby there is a lot of excitement which we are seeing in the equity markets. And especially if what I'm noticing is that there is a lot of excitement around the mid and small cap space. But definitely, the nuances of investing in mid and small cap, investors need to be aware of the risk attached also, by how do you actually invest in this space. Globally, markets have been very choppy. In fact, they've fallen quite a lot. And what we have seen is that in spite of this fall, India has been fairly resilient. In fact, India has, there was a correction, there was a rebound. We are almost near the 52, the all-time high, which we have seen in the Indian equity markets. If you compare that with mid and small cap, I think the mid cap space has done fairly well. In fact, it is somewhere at the high. In fact, the mid cap dice. So I just thought that this is the appropriate topic for this Samvat, because what we at Cedrus, our view is that mid caps are expensive, small caps may be expensive, but definitely India is an emerging market in the global scheme of things, and we are well positioned to take advantage because of the stable government, the policies, the China plus, Europe plus, which we keep talking about, whereby the manufacturing sector is apparently seeing a lot of activity. And we believe that there will be re-rating, but definitely as an expert, we would like to understand your views and how should investors approach this space. So, Mr. Maran, we have six questions which we'll ask you, and I'm sure investors will benefit from your views on the mid and small cap space in the equity markets. For the investors' knowledge, this is a moderated session. Post the interview, you can type your questions in the and we will ask that to Mr. Maran, in fact. So, Mr. Maran, should we begin?
Thank you. Thank you for the generous introduction. Thanks for giving us the opportunity. Great to be with you. Look forward.
So, sir, our first question to you is apparently Indian markets fell with the with the global markets. They did fall less than the most of the developed markets. I think they fell by about 18% from the peak. But we have seen a good amount of recovery post June. Uh, Within the recovery also, if I just look at it, mid caps have specifically recovered completely, and on a 1 year basis also we see the mid cap indices are actually in positive compared to the Nifty, in fact. So they've been fairly resilient. So my first question is, any specific reason you feel that the mid caps is seeing a good amount of resilience compared to the larger caps?
Okay. Before I answer the question, let's take a minute first to describe the large, mid, and small. Because, like many things in India, listed equities market in India is also so divergent in nature. Any singular observation by overgeneralizing the universe could be misleading. For example, we can't overgeneralize whole stock market into one view. We can't overgeneralize whole large caps or mid caps or small caps into one view. Because when you buy an equity, you are buying ownership interest in a business over a long period of time, say 5, 10, 15 years. How much we make in that equity is function of that company's earnings. And when you put different stocks in an index form and then call it as large cap, mid cap, small cap, till 2017 December in India, we didn't have any uniform definition of large, mid, small. Our regulator SEBI came with this clarity in 2018. Instead of defining a company based on the size of the company in isolation, they said, let's do relative ranking, put all the companies in a descending order market cap. Company number 1 to 100 is large caps, 101 to 250 and mid caps, and 250 to 500 as small caps. Our markets are extremely skewed, not recent phenomena. It had been like this 20 years back when Unifi was formed in 2001. If you take, say, the top 100 companies, there were 83% of then prevailing market cap. Even today, the top 100 companies, what we call as large caps, is about 75-80% of India's total universe. Actually, the first 50 companies, Nifty companies, is two-thirds of India. It's a skewed market. Why I take some time to explain is your question on mid caps. That's about company number 101 to 250. Unlike the top 100 large caps, which is 70-80% of India's market cap, but within this top 100 names, large caps, hardly 20-30 stocks make up 60-70% of the large cap universe. That's not the case in small and mid caps. They're much larger universe and there is no skewness in that universe. Within this definition, the industry mix in large caps are very different. For example, most people even now use Sensex and Nifty as a reference number to judge what's happening in markets. Even though Sensex has only 30 stocks, Nifty has only 50 stocks. Do they indicate what's happening in a market which has 1,900 different companies in NSE, 4,000 plus companies in BSE? They may not. But still, the reason why people often use the 30 stock Sensex and 50 stock Nifty to judge what's happening instantly in market is there may be just 50 companies in Nifty, but they are two-thirds of the total market cap. And if they are cheap, whole market appears cheap. If they are expensive, whole market appears expensive because they are two-thirds of the investable universe. Whereas in mid caps, the industry composition is very different from 30 stock Sensex, 50 stock Nifty, or 100 stock large caps. The 30 stock Nifty, Sensex, and 50 stock Nifty, if you take a closer look, almost 35 to 40% are financials, 15% IT, 14% FMCG, consumer goods, 11% oil and gas, 10% pharmaceutical. I just talked only 5 sectors. I'm not even counting 6-7% in auto, another 6-7% in metals. Just 5 sectors in the large cap universe make up 70-80% of Sensex, Nifty, and large caps. But they are not 70-80% of mid caps. There are several businesses in India where the largest player may still be a small cap, mid cap only. Take our industry, wealth management industry, which advises investors who are all joining this event on mutual funds, PMS, AAF, REITs, several asset classes. So in the last 10 years, if you look at the large cap universe, the index would have grown hardly maybe 10% per annum. Is that the rate wealth management industry has grown? No. Our industry has grown much faster rate. In the last 10 years, mutual fund AUM has grown from 9 lakh crores in 2012 to 40 lakh crores today. That's 17, 18, 19% per annum. PMS industry has grown even more. So the Indian wealth management industry has grown a lot. But the largest wealth management company, if you ask yourself, is a small and mid cap. They have 1.5% share of the industry. There's no large cap in our industry. But if you take a business like insurance, there are only large caps in insurance. You can't have a small cap insurance company. So the industry composition could be very different in large cap, mid cap, small cap. There are only few sectors in India like financial services, IT, pharma, where you have large caps, mid caps, small caps. But there are several businesses in India which may not have any large cap. Most of the names in those sectors could be small and mid caps. So the index performance, while on daily, weekly, monthly basis, could be somewhat similar. You can't have a day when Sensex is down 1,000 points and small and mid caps are up. And you can't have the opposite also. But it is possible over a long period of time, in a longer tenor, how much small cap, mid caps, large caps do is a function of the businesses that are dominant in that sector, in that index, and what's happening in the earnings profile of the companies in that index. I will elaborate that a bit if you allow me to share my screen. Is my screen moving?
Yes, it's moving.
Okay. So, can you see this graph which has the 20-year data of large, mid, small?
Yeah.
Yeah. The blue line is Sensex large caps. The red line is mid caps. Green is small caps. So it is not that small mid cap index gives higher return than large cap or vice versa. What you will find is in a rising market like 2003 to 2007, when blue went up, which is large caps, the red went up much more, mid caps. And the green line which is small caps, it went up even more. But in 2008 crash, they all crashed and converged. Again, 2009-10 bull market, mid caps rose more, small caps rose even more. But in 2012-13, they converged. So what I'm trying to say is, in a rising market, mid caps rise more, small caps rise even more, and in panic, they all crash and converge. Now, to answer your question, what has happened in mid caps last 1 year, 2 year, 3 year? How do they move differently? So what I will take is, so today we are in October 2022. Take last 3 years. The line graph is the Sensex to be seen with the left-hand side y-axis. Each dot is each Sensex company's 3-year return to be seen with the right-hand side y-axis. So what I'm trying to communicate is the 100 rupees invested in Sensex in September 2019 by March 20 would have become little less than 80. And then by September 21, it would have become 160. And right now, maybe end of September, it was close to 150. So how much Sensex has moved between September 19 to September 22 is about 50%. 100 rupees in Sensex after going down to 80, after going up to 160 is now 150. 100 has become 150 in the last 3 years. If you look at the dots, each dot is each Sensex company's last 3-year return. I just spread the dots wide enough for optical clarity, but each dot is each Sensex company's 3-year return to be seen with the right-hand side y-axis. During the same years period that Sensex moved 50%, there is one Sensex stock which has gone up almost about 200%, and there is one Sensex company which has given negative return. But maybe about 15-20 Sensex companies' returns are between 40 and 80% when index went up 50%. So the divergence of companies within Sensex, that their divergence with Sensex, only one stock is an outlier at 200% return, one stock is an outlier with negative return, but majority of Sensex stocks gave somewhat closer to index return. When you expand this list to, let's say, the large cap universe, which is instead of the top 30 Sensex companies, if you take the top 100 large caps, the 100 rupees invested in large cap index in September 19 by March 20 would have become closer to 70 because you widened the universe instead of top 30 to top 100. When markets fell in during COVID time, these 100 stocks large cap index fell 30%. So 100 became close to 70. And then by September 21, they had become 160. And even today, maybe as of September 22nd, they were at about 155. So how much large cap index has moved during this 3 years period is 100 became 70, became 160. Now it is 150, 155. So during this 3 years period that the large cap index has moved about 55%, look at each dot. There are, if you count the total dots, you will get 100 because there are 100 large caps. Out of 100 large caps, maybe about 10 large caps have gone up between 200 to 280%. And there are some 10, 15 large cap which are given negative return. And what I'm trying to say is the divergence is even more.
Right.
And if you see that in mid caps, divergence is a lot more. And if you see that in small caps, absolutely there is no pattern.
Absolutely.
So 100 rupees in small cap index by September 19 would have become 70 by March 20, and then they became 220. When Sensex went up 60%, small caps went up 120%. But
Hmm.
when small cap index went up 100%, not all small caps went up 100%. There are several small cap which have gone up 200, 300%. And there are
Right.
several small caps whose prices today are lower than what they were 3 years back. So what I'm trying
Hmm.
to say is, unlike Sensex or Nifty or large caps, where index moves in one range because majority of the stocks moved in that range, you will find small mid cap index stock level divergences a lot more. And index is nothing but combination of all these businesses, and therefore making sense of small cap and the mid cap index movement could be
Hmm.
very misleading and may not be that useful for us to take investment decisions,
Hmm.
because what drives small caps and mid cap indices are
Hmm.
several hundreds of companies, and making one
Hmm.
sense out of them may not be the right thing to do so.
Right. Right. No, I think it was very clearly explained. So what we can understand is that you buy businesses, you don't buy a mid cap, small cap, or a large cap stock. Okay, it's
Yeah.
basically you need to buy a business, irrespective of what capitalization they are. In fact, my we'll go to the next question. In fact, is the manufacturing sector. This is very specific to manufacturing. Is experiencing a 1991 moment. The earnings are the order books are full. The earnings have been very good actually in the manufacturing space, and that was more to do with the on the back of the China plus Europe plus effect and the government support which they are getting in form of the just for example PLI, okay, the productivity linked incentive scheme which they have floated, uh, and the Make in India, in fact, where a lot of goods are now made in India, so that we have less reliance on imports. Citing this higher weightage of manufacturing, because if I've just done a little bit, I'm sure you have more points you can add to that. But manufacturing has a very high weightage in the mid and small cap. Like you have mentioned, we are not now talking about the mid cap, small cap, but I'm just talking of the weightage, specific to manufacturing. So they are in that lower down the order, in the sense the mid and small cap space. So do you feel that this 1991 moment is there to stay, in the sense that this rally will continue, and there is a lot of valuations, attractive valuations, which you see in this manufacturing space?
Um, I will again and bring begin my answer to the second question the way I started the first one,
Right. Hmm.
which is overgeneralizing sometimes could be very misleading.
Hmm.
Um, Two mistakes we should not do today.
Hmm.
First is looking at the economy and the drivers of businesses in that economy,
Hmm.
and use those inferences while doing stock selection or sector selection in markets.
Hmm.
Both are very different. You can be extremely bullish in economy and still be skeptical of markets,
Hmm.
or vice versa. You may be skeptical of economy.
Hmm.
This disconnect between what's happening in economy and what's happening in markets
Hmm.
has been well documented with sufficient data points in the past, but somehow in our mind we still try to link the
Hmm.
positivity in certain sectors in economy with the same similar positivity of those sectors in market.
Hmm.
For example, between 2008 and 13,
Hmm.
the our GDP went 8.5% per annum.
Hmm.
Our nominal GDP almost doubled in those 5.5 years, because those days our nominal GDP used to grow 13-14% per annum.
Hmm.
And in those 5 years, that's the only 5 year plan where our actual power generation was more than the initial target. It was
Hmm.
heavily driven by capex. And those 5 years, real estate prices went up 3 times, construction activity quadrupled. But what happened to the stock prices of companies in those sectors? They didn't do anything great. In fact,
Mm-hmm.
Sensex and Nifty were at the same levels in 1st January 2008 and 15th July 2013. 5 years, 7 months, 15 days, no return.
Mm-hmm.
And in the same 5 years, 7 months, 15 days, our nominal GDP more than doubled. And many of the
Mm-hmm.
sectors which I just mentioned had tripled and quadrupled. But
Mm-hmm.
shareholders' return in those sectors were horrible.
Mm-hmm.
Take last 2 years. March 20, we had COVID initially. And if we take since then last 2 financial years, first financial year our GDP went down minus 8, 8.5. Next financial year GDP went up plus 7.5, 8. More or less our GDP in March 22 was where it was in March 20.
Mm-hmm.
But within these 2 years, I just showed you Sensex was up 50%, large cap index was up 60%, small and mid cap were up 80, 90%.
Mm-hmm.
But the economy was at the same levels.
Mm-hmm.
So it is not Sensex and Nifty's job to show what's happening in the economy.
Mm-hmm.
If our economy is going to grow because real estate and construction activities driving that growth, what is real estate and construction weightage in Sensex and Nifty? Not even 2, 3, 4%.
Mm-hmm.
On the other hand, last 2 years, our economy shrunk and then grew more or less back to where it was pre-COVID. But these 2 years, banks' businesses were never disrupted. IT businesses actually benefited from. They were not negatively disrupted. But these 2 years, the construction activity had shrunk, tourism business had shrunk, and these are all very dominant businesses in GDP. So GDP shrunk, market did not. So to extrapolate from the historic inferences, today you can be fully bullish on PLI and capacity utilization and capex and economy as a whole, but that doesn't mean we should jump and invest in manufacturing, because there is a disconnect between economic activity and shareholder return, because both are not same.
Right.
For example, take last 5 years our own markets.
Mm-hmm.
You may agree that between 2017 and 2022, the total volume in securities traded in India, NSE and BSE, two stock exchanges, the number of shares traded in stock exchanges in the last 5 years have more than doubled. The price at which these stocks trade is up 50, 60, 80%.
Mm-hmm.
And does that mean brokerage income of all brokers have grown? No. 80% of the brokers are out, right? And during the same period, if you take top 5 stockbrokers of India in 2017, and the last 5 year shareholder return in 2 of them are minus 50%.
Mm-hmm.
During the same period, that the brokerage industry has gone up more than double. So I think what could happen is manufacturing as a sector in our economy will do exceptionally well. In some type of manufacturing, it can grow a lot more than what we have grown in the last 10, 15 years. But that doesn't mean every listed stock in that space or majority of the listed stock in that space could benefit from that growth. It will be too divergent in nature. There will be few names in manufacturing which could be 3x, 5x, 10x stories. And there will be a lot more names in manufacturing which could be worse 5 years from now than what they are today. Yes, sir.
Mm-hmm. No, so definitely, that is something which the investors should leave it to the expert as to what kind of a stock to pick. In fact, which company would do well over a period of next 5 or 10 years, and like what you mentioned from the previous question, that identify good companies, good businesses, and do not look at large, mid, small. I think that is something which is just a way the market behaves. In fact, I'll actually go through the more generalized question now. That India has been a bright spot in the global scheme of things. We have seen India is very well placed. If you just see the GDP has grown, it's been one of the fastest growing economies. But with US and Europe, if there is an imminent recession next year, don't you feel even India will suffer? And this is more of a general view, which if you can just answer.
Will India suffer? The answer is yes, but to what extent is where
Hmm.
people differ.
Hmm.
Um, some of this notion many investors got of late is we are highly integrated economy and we are highly integrated markets with global markets and global economy. The answer is no.
Hmm.
If you look at our economy, 3.5 trillion, maybe about 17% of our GDP is exports.
Hmm.
62% of our GDP is domestic consumption.
Hmm.
So if things go terrible in US and Europe, will there be no impact at all in Indian economy? The answer is no. There will be an impact. But is it going to be huge impact? Not necessarily.
Hmm.
If you are a shareholder or an entrepreneur in
Hmm.
IT industry, and 70-80% of your revenues come from US and Europe, of course you should
Hmm.
be concerned about what's happening in those economies.
Hmm.
Or if you are an entrepreneur or a shareholder in a company which employs tens of thousands of people and exporting 100% of them to US and Europe, textile
Hmm.
exports or engineering imports, then you should be concerned about what's happening in US, Europe, China, Russia.
Hmm.
But if I am an entrepreneur selling pressure cookers in Chennai, should I
Hmm.
be concerned? We may not have to be.
Hmm.
So, if you understand what is driving our economic growth,
Hmm.
and if you understand what is likely to drive that growth, why we are resilient. We are not resilient because we are extremely competitive and we can beat every competition in all the export markets. We are a lot more resilient because we have a strong domestic economy,
Hmm.
and within the domestic economy we have a very strong domestic consumption, which thanks to demography and our urbanized nature, the drivers of that growth are very intact. And
Hmm.
that, if we spend some time in understanding that growth and how resilient that growth could be and why they are not that super sensitive to what's happening in US and Europe, then we'll get enough confidence saying that if things go that terrible in US and Europe, there will be a small section of Indian economy which could be negatively impacted, but not
Hmm.
whole of economy, because majority of Indian economy is sensitive to what's happening in India. They are not
Hmm.
sensitive to what's happening in US and Europe, but that kind of impact you may find in few dominant businesses in Sensex or Nifty, like
Hmm.
IT or oil and gas. But their
Hmm.
relevance is not that large in Indian. For example, before COVID struck in March 2020, if you had asked people which is the largest business in India, and if you give choices like IT, travel and tourism, and textiles, most people would have chosen IT. But people
Hmm.
find it very hard to believe in India that the travel and tourism is a larger industry than IT. But
Hmm.
when it comes to market caps, IT has much larger weightage. So
Hmm.
to answer your question, the sensitivity of our economy to what's happening in US and Europe could differ from business to business, and what business is dominant in which segment. in Sensex or Nifty or market caps could be very different from what is dominant in economy. And therefore, for us, while some of the developments in Western economy could have some impact on few sectors, I don't think it will have any dramatic impact on whole of Indian economy. Yes, sir.
So what we could understand is that we are fairly resilient because we are more domestic driven, and
Correct.
definitely if the global markets there is a correction, we will also fall, but we may fall more or less, not in line with the way the global markets have fallen. In fact,
No, no,
uh,
no. I think one clarification there. We are linking global markets with the
hmm,
global economy and Indian markets in the neck. For example, my answer all along had been the impact of global economy, slowdown,
right,
recession in Indian
yes,
economy.
right,
But Indian markets, as I mentioned,
hmm,
are not
right,
truly reflective of Indian economy or vice
true,
versa.
yeah,
There could be some impact of global market decline on Indian markets, but
hmm,
it is very different impact than global economic decline having with Indian economy. The
hmm,
technical aspect of market fall has been more resilient in India because even though FIS have been investing in India since 1993, and they
hmm,
were very large dominant part of Indian shareholding base. For example, if you take last month market cap of India, the total market cap of all stocks across all market caps across all stock exchanges in India, that's about 283 lakh crores. That's India's market cap in dollar terms, close to $3.5 trillion. If you ask how much FIs own, they own about 19%.
hmm,
Indian promoters own 54%.
hmm,
Domestic institutional investors, which include all mutual funds, insurance companies, LIC, they were about 14%.
hmm,
The balance 13% is what you, me, portfolio managers, retail investors, big family offices, they own. So this 19% FIS own is almost out of 45% free float. 19% FIS own.
hmm,
When 2008 or 2012-13, when FIS became big sellers in globally and
hmm,
as well as in India, the
hmm,
impact of their selling in India was extremely powerful
hmm,
because they were owning little more than one third of the free float of India.
true,
If if the total market cap of India is 100 and promoters own 54, the balance 46 is what is free float. Out of
hmm,
that 46, 19% is owned by FIIs.
hmm,
But what we have seen in the last 2 3 years, even though the media is screaming that FIIs are selling,
hmm,
it's not that FIIs are one type of entity. There are again different types of FIIs. You
hmm,
have endowment funds, big pension funds. That's one type of FI.
hmm,
Then you have the regular hedge funds, private equity funds. Then the
hmm,
third are what we call as ETFs. These are all
hmm,
multi-country, multi-asset class, just index passive investors.
hmm,
So what we have seen as aggressive selling in the last 1 2 years is the third category, guys, the ETF sellers. The endowment funds and big pension funds, they are not big sellers. But the
hmm,
resilience of India is added one more extra factor in when it comes to market because of the domestic liquidity.
hmm,
And that domestic liquidity, if people spend some time in understanding where is it coming from, that's not institutional capital. That's not money few households in few metros are diverting from other asset classes to India. So that explains why the number of demat accounts in India was 2010 was 2 crores, 2018 was 3 crores, 2024 crores, and 2022 was 10 crores. And if you understand how mutual funds in the last 4 years have raised more money, collected more money from investors than the previous 25 years.
Mm-hmm.
PMS managers like me, there are maybe SEBI registered 347 PMS managers. And if you take all the AUM PMS managers have raised from 1993, when PMS guidelines came, till 2018, is less than what portfolio managers have raised in 19, 20, 21.
Mm.
So the money that has come into portfolio managers last 3 years is more than the previous 25 years. This kind
Mm.
of high domestic liquidity is not just coming from Bombay and Delhi. It's coming from wider. The last multi-cap fund of SBI mutual fund had got
Mm.
investors applications in 92% of 19,000 pin codes in India.
Mm.
That gives you a sense of wider nature of the domestic liquidity. And that liquidity is not a one-time phenomena. According to us, it's a beginning of a much longer term trend. And
Mm-hmm.
that will add a lot more resilience to Indian markets. So sometimes what happens when, even if valuations are attractive, if the large shareholders themselves become sellers and it is not
Mm-hmm.
met with proportionate strength in buying, then such markets could be very vulnerable and more volatile, which is what we were 10, 12 years back, which is
Mm-hmm.
not where we are today. So we are more resilient in economy and lot more resilient when it comes to markets in India, and we don't have to be unduly worried and concerned about the global economies and markets. Yes, sir.
Right. Yeah. No, in fact, the interest which we are seeing from a lot of individual investors, domestic investors in India, that led to, us, naming this, the topic which we named was that risk hai to ishq hai. So, one thing is that, is it that now investors are forced to take more risk to get better returns, or they are getting into equity, citing that they are more comfortable with the long term prospects of India, in fact. So, in fact, there was an article which came in the newspapers also, which was basically, will it be India's decade or India's century? And in fact, this was our last knowledge series topic also. So, your thoughts on the same, that, there is domestic liquidity coming through individual investors. Smaller cities investors are investing. That is it more to do with the interest rate cycle itself, that the interest rates are low, and if you want a better return, if you want to beat inflation, you need to actually start investing in equities. That is something which the investors have understood. Or second part is that, they are confidence of the India's prospects, where they feel that they will get a superior risk adjusted return in equities than previously, in fact. So could you your thoughts on this?
Um, yeah, both are partly the reason, but major reason is somewhere else. In economics, I'm sure you might have heard a term called the invisible hand.
Hmm.
The invisible hand is something which plays a role in many things, but it's invisible. That's the primary reason it is moving, but we are not able to see.
Hmm.
The biggest invisible hand in India is the demography. Right? If the flow to equities were more in the last few years because interest rates were low and people are shifting to equities, then the flow to debt mutual funds should have reduced. It did not.
Hmm.
Then why is it that SB account balances, current account balances, term deposits were all-time high with banks?
Hmm.
So the flow to mutual funds between 2018 to 22, their mutual funds raised more money than the previous 20 years. But
Hmm.
during the same period, bank balances were at all-time high. Current account balances all-time high. SB account balances all-time high. Flow to debt mutual funds were all-time high. But what we didn't realize is between 2011 and 2016, the entire household investments into gold was $52 billion a year. Between 2017 and 22, it was only $39 billion a year. Unlike these two asset classes, in real estate, you don't have statistically precise number region-wise, but we all know the household investments between 2017 and 22 in real estate were much lower than the household's investment between 2011 and 16. On the day of demonetization, 8th November 2016, if you take in the entire Indian private household wealth, the private household wealth of India, it was close to about $9 trillion in 2016. Almost about 80% of that was real estate. About 6-7% were in gold. 2.5% was in equities. And about 7.5% were all financial assets, other financial assets like bank deposits. Close to about 2.5% were chit funds, mostly in South and East India. That household wealth, which was in equities, that was about 2.5%, had now become close to 5.5%. Which is why the household investments in equities in the last 5 years is more than the previous 25 years total. When we give these statistics, many people look at it as if same investors did something different later. It was no. It's different investors. For example, if mutual funds have raised more money in the last 5 years than the previous 25 years, then why is it that HDFC AMC stock price came to all-time low? In fact, 5 years back, HDFC was the largest mutual fund, and SBI was nowhere in the top 3. Today, SBI is the largest mutual fund. Not marginally. The second, third, fourth guys are all 10, 15,000 crores difference AUM, but the first guy had 2.5 lakh crores AUM. If you understand where the flow was coming from, then we'll understand why HDFC was the largest mutual fund 5 years back, and mutual fund industry doubled and the stock hit all-time low. Right? About 10 years back, when mutual fund AUM was about 9 lakh crores, 46% of that AUM came from investors in Mumbai. 16% came from investors in Delhi. That includes Noida, Gurgaon. So 62% of the mutual fund AUM were 2 cities. Then we had city number 3, Bangalore, 4, Calcutta, 5, Chennai. Put together, these 3 cities were about 12%. Then you had city number 6, Ahmedabad, city number 7, Pune, all the way to city number 30. They were about 18%. City number 31 to whole of rest of India was not even 8%. And from there, if you take city number 31 to rest of India, from 8% of 9 lakh crores, they have come to 23% of 40 lakh crores. So this liquidity that was flowing into markets is not just flowing into equities, it's flowing to financial assets. A part of it came into equities. Within that, a part of it came into mutual funds, other part went to PMS, other part went into direct equities, small case, and many other stuff.
Sorry.
The larger portion of it was more a financialization of savings. And financialization of savings was a lot more in tier 2, tier 3 towns, because that's where it was skewed before 2016 in favor of financial assets. But the biggest invisible hand here is the age. What is the age of the savers? It has undergone a change. If you take, for example, the real estate savings itself, the average age of a home buyer, right? In 2001, it was almost about 43. Last year, Pune became the first city in India where the average age of a home buyer broke below 30. Today, it is 29. So if you take the average age of a home buyer in whole of city of Pune as 29 years, 3 months, it is not just on the home buyer side. for example, if you take India's largest broking firm, and they give the statistics, if you take all the demat accounts opened in the last 2 years, almost about 61% of the demat accounts were opened by people aged below 30. So does it not say something? It tells you that it's a new saver. A new saver is saving a lot more in financial assets. If two-thirds of India is aged below 34 and half of them are women, women in 20s, 30s are not buying as much jewelry as women in 20s, 30s bought in the previous generation. So a large change that has happened in financialization of savings is here to stay and probably will gain further momentum in the coming years. And flow to equities gained not because they were all upset with low interest rates and therefore if interest rates rise they will go back there. No. If we had spent some time in understanding who's saving and where was he saving before, that gives you enough and ample um, you know, data points that this is not a one-time event. This is the beginning of a much longer-term trend. Yes, sir.
No, in fact, that's something which was something which I'm sure, including us, most of us didn't realize that it is coming from a demography which is, of a very age which is much lower than the previous investors. But that definitely gets, us to, that they are taking more risk and they're taking risk on the financial assets. In fact, I don't know how true it will be, but I have heard one of the experts say that Bollywood was the once upon a time in religion. Cricket was a religion. I think this is an exaggeration, but we really don't know. They feel that going ahead, equity can be the next religion actually, where a lot of money will flow into equities. Because of, I think, again coming to the same point which you put in, that it's a different set of investors. They are typically young investors who are ready to take risk, because I guess they are much more comfortable compared to their parents in their jobs, and they can take that risk just because of the comfort which they have. uh, you know uh, Coming to this itself, that now, as you mentioned, that 54% of the equities is actually owned by promoters, and you have such a huge chunk of money which is flowing into equities, in fact. And this, I'm again not generalize, I'm not trying to generalize into small cap, mid cap, I'm not bucketing it, but if 54% is with promoters, and if they're the kind of money which is flowing in, do you feel that itself is going to provide a huge opportunity in equities, because the valuations will definitely become expensive, but the earnings also have to be in line with the val the prices, in fact. So how would you counter that actually?
If liquidity flow to markets is the only reason markets rise in absence of earnings growth, then trader may benefit. As an investor, we will be very paranoid. We'll be skeptical because we'll make a lot of money in the short term, and then we'll get into long years of no return because earnings has to catch up. But that's not the case. Just because liquidity is flowing in, see, promoters take 54% is an indication of our culture. It's been like this in 2001. In fact, before 1991, there's no private IPO, there's no private equity, there's no venture capital, there's no private sector banks. There were only public sector banks, and risk taking was only entrepreneurs could do. This is unique to India. If you take the top 10 stock markets, no other market you will find where promoters own 54%. For example, if you take US, promoter stake in US is 6.5%. 80% of the equities in US are institutionally owned. And something similar in Europe. In China, 62% of market cap is government.
Right.
India is the only major market where you will find promoters are the dominant investors, which is why we had some strategies like insider shadow fund, where we buy only when insiders increase stake, which are extremely contrarian. right?
Mm-hmm.
For example, in March 2020, when markets fell the most,
Mm.
who are the biggest sellers? FIs were the biggest sellers.
Mm.
But who bought when FIs sold in March 2020? Not DIIs, not mutual funds. It's the
Mm.
promoters who bought the most.
Uh-huh.
Yeah, for maybe um, is my screen moving?
Yeah. Yeah.
So here, the yellow line is mid cap index,
Mm.
and each bar is each quarter number of companies that promoters increase stake, to be seen with the left hand side y axis. For
Mm-hmm.
example, if you take the quarter 2 FI20, that's March 20, right?
Mm.
Don't you see the line of March 20 is the second highest after 2008?
Yes.
What it means? It means insiders are the biggest buyers in March 20.
Mm.
Last September 21, when market hit all-time high 60,000 Sensex,
Mm.
what did promoters do? Their buying was the lowest in the last 15 years.
Mm.
What does it tell you? It tells you there is a merit in tracking promoter activity. Correct?
Mm. Mm.
Should we buy a company when promoters are diluting stake, or should we buy a company when insiders are increasing stake? We
Definitely when
should buy
promoter.
when,
Yeah.
yeah, March 20 promoters are increasing stake. Last 2 years, promoters are not increasing stake. Last 1 year, they were actually busy diluting stake. Number of companies promoters diluted September 21 last year was a all-time high. Number of IPOs in India, all-time high. Number of companies
Mm.
insiders increasing stake, all-time low. That's
Mm.
precisely when you should not be buying.
Mm-hmm.
So these are all some of these inferences we make, which is why we always call ourselves as thematic investors. We are not specialists in small caps or mid caps or large cap. That's the impression many people got. At,
Mm.
none of our funds were positioned based on market
Mm.
cap or any sectors. We are
Right.
agnostic to the market caps. We are agnostic to the sectors we invest. But we may
Mm.
have a theme like which attracts only insiders activity. We had a theme which attracts only in
Mm.
demergers, spin-offs. We had a theme which
Right.
attracts only holdcos and holdco
Mm.
discounts. This kind
Mm.
of thematic investing, different time periods you will find. For example, about a month back, we did a fund where we track only consumption activity,
Mm.
that too only domestic consumption, and within that we focus only on discretionary consumption. So you will
Mm.
find the whole portfolio full of companies in home electricals, kitchen equipments, consumer durables,
Mm.
hotels, hospitals, broking, wealth management, insurance, but you won't find a single IT company, or
Mm.
you may not find any commercial bank. You may not find
Mm.
oil and gas. You may not find auto, which
Right.
means these are all businesses which are very, very thematic in nature and
Mm.
could sometimes move in opposite direction to what market moves. But
Mm.
to answer your question, if lot of liquidity comes in market, and if
Mm.
half of the equities are anyway promoters own, only the
Mm.
free float is so less, and large money chasing less free float will make the stocks very expensive. The only
Mm.
assumption in this you are making is no new idea, no new stock listings will come. It is not
No,
so.
if no,
If
the
the
new list.
liquidity comes in,
Yeah. Yeah.
if the
Uh,
liquidity comes in, and
mm.
if valuations are attractive, you will find hundreds of IPOs sucking that liquidity
Mm.
out.
Mm.
Uh,
Uh,
there is one
yeah.
investor I know who's top five richest Indian who made most of his money in equities, and he is very media shy. You will never find him in any forum.
Mm.
And he used to say that in chaste Hindi, which I don't know how to exactly translate, but I will try
Uh,
to tell you what he actually meant. He said,
uh,
if valuations are absurd and lot
uh,
of money comes in,
mm.
hmm, uh, even the walls behind you,
Mm.
right, will throw stock.
Okay. Mm.
But if the valuations become very attractive,
Hmm.
Even the rock will suck water.
Hmm. Hmm.
So don't, you may find both extremes happening.
Right.
Like when SEBI regulations came in 2018 defining each mutual fund, large cap, mid cap, small cap, a lot of liquidity went out of small and mid caps.
Hmm.
So for a year, the small and mid cap stocks declined a lot because absence of liquidity, which was an
Right.
opportunity if you're a contrarian.
Hmm.
Similarly, last year, in the fag end of 2021, a lot of capital came into small and mid caps, disproportionate to what it can absorb,
Hmm.
which is the time you should be out. So,
Hmm.
which is what we did. We reduced our small and mid caps last year, but in 2018, almost all the money we raised in that year went into small and mid caps. So you need to be a contrarian in that. But what I'm
True.
trying to say is, to answer your question, if more liquidity comes into market, and if
Hmm.
54% is not in free float, the balance
Hmm.
46, if it is no new IPOs, then a lot of money coming in will inflate the stock valuations. That's exactly what happened in Japan in 80s. The index
Hmm.
itself went into 65 PE because there were
Hmm.
no new names coming into the index, but all the money went into those index stocks and they became very expensive. And we are unlikely to be in that kind of situation, because if large money, large liquidity comes in, there are
Hmm.
several other businesses which will come and get a portion of the liquidity by coming with new listings.
Right. Right. No, it's so aptly said, and definitely, your this slide on promoters buying when the markets fall. In fact, this is something which is a very unique, point which I have not. We typically talk of DIs and FIIs and domestic investors and institutional investors, but we have never, noticed that promoters themselves are also big investors when the markets fall. In fact.
Absolutely.
Uh, yeah. So, Mr. Maran, my last this thing is any specific, because you run a very unique strategy in in Unifi, and you have mentioned quite a few of them right now. Any specific strategies which you would like to discuss, through your presentation, which apparently is something which even we have been discussing since a while now. In fact, so anything which you would like to throw some light upon?
More than, yeah, our strategy, I will share with you few reasons why we launched this new strategy that we did few months back.
Hmm.
First time, about 5 years back, when India introduced GST guidelines, it
Hmm.
was a huge disruptor.
Hmm.
When quite often, I'm sure you may hear this word called disruption.
Hmm.
Disruption is a very strong word which gives you a sense of something fundamentally changing.
Hmm. Hmm.
Most people understand technology disruption.
Hmm.
Like our own industry, when I began my career in 91, there used to be 1,200 stockbrokers in NSE doing manual trading.
Hmm.
But when NSE came in with VSAT terminal, satellite technology, transparency, all the regional stock exchanges had to be closed.
Hmm.
Today, little more than 60% of the business daily volume in exchange happens through app-based trading platforms.
Hmm.
So technology disruption.
Right.
And GST is a regulatory disruption.
Right.
RERA in real estate is a regulatory disruption.
Hmm.
Whenever disruption happens, one thing you will notice, the impact of these disruptions are not uniform for all players.
Hmm.
Small marginal regional players get deeply impacted, and
Hmm.
large organized branded players actually gain market share.
Hmm.
And over a period of time, the industry tends to get consolidated in few hands,
Hmm.
which invariably we call them as matured businesses because they already got consolidated in few hands. In India, one thing you will notice is, usually when a new business opportunity opens up, you will find hundreds of guys jumping in. few do it well, and those few tend to grow faster than the rate at which industry is growing. And that growth gives them enormous scale of economics benefit, which in turn allows some of them to invest in technology, talent, and that in turn helps them to grow even further. And when slowly regulations come in these businesses, the large scaled players are better equipped to follow these regulations, and therefore either small guys get acquired or they leave the industry. So, for example, if telecom opens up in India in 1990s, you have 40, 45 companies. Today, 90% of the business will be 2 or 3 guys. Similarly, when banking licenses were given by RBI in the early 90s, you had some 30, 40 banks. Today, just 5 banks control 82% of banking deposits. And if you take, say, IT industry, when IT industry opened up early 90s, we had 6,200 IT companies as members in NASCOM. But we don't realize 5 IT companies are more than half of the industry today. If you look at all the FMCG companies like Lever, Asian Paints, Titan, DMart, they all will have 40, 50, 60% market share in the business they operate. Oil and gas industry, some 5 companies will be 93% of the industry. Automobile, whether it's two-wheeler, four-wheeler, heavy commercial vehicle, 3 guys will be 70% of the industry. And they were all not like this 20, 30 years back when the industry got opened up. Right? You would have had several players like telecom, 40 guys becoming 3. In automobile also, some 10, 20 companies became 3. So this is what is called business consolidation. So this fund that we did 5 years back, we called that as BCAD, business consolidation after disruption. Because only after disruption, businesses consolidate. During good times, you will find newer and newer guys jumping in. Businesses get fragmented. But the fragmented businesses at times of disruption consolidate. And GST was a great disruption in trade. So we built this fund and it's done reasonably well. But post-COVID, there were few changes that we were able to observe. And many people initially were attributing those changes to COVID and lockdowns, because it's very natural in India when something happens, people look for reasons around near-term events, and they don't think something that happened 5 years back, 10 years back, or something which is likely to happen 5 years forward is already playing out. For example, when number of demat accounts opened in the last 2 years was more than the previous 20 years total. Initially, media was writing that people are stuck at home, they have nothing else to do, they are just opening demat accounts, dabble in stocks. And once normalcy comes back, many of this activity level will decline, which didn't. Actually, normalcy came back, activity level further went up. So some of these narrow framing of inferences could be misleading. So consumption change is a dramatic event that we are undergoing. We are not noticing it. The demographic element in the domestic consumption, it is not that the demographic element is playing only in the manner in which households do savings. It is playing a role even in the manner in which the households are consuming. The household's attitude towards credit is very different today. Your generation and my generation was different, and your generation and maybe the new generation is very different in their attitude towards credit. So this fund focuses only in the discretionary consumption of Indian households. We call it as breakout 20 because if you put Indian consumers, they are not one type of consumers. If you put all the 140 crore Indians on an average 4.5 people per household in a scale of 1 to 100, and we know we are a highly unequal society where the 80 to 100, the richest 20% of India was the biggest consuming class. And probably they explain majority of the consumption of many products that you and me are familiar with, whether it is smartphones or wealth management services or air conditioners, washing machines, many kind of products. But the biggest consumption growth that we are seeing are in products where the 60 to 80, The next 20% of India is also coming into the consumption class,
Right.
which when you take it helps you to distinguish. Say toothpaste may also be consumption, footwear is also consumption. But in the last 10 years, toothpaste consumption has grown only 1.5% per annum. But footwear consumption has grown 10 times of that number. There should be some logical way to explain a 10x difference between two consumption items. And the only way you can explain that is by giving ample data points. And if you visit our website, you will find several materials. None of it is to do with global macros or global markets or economy, but it will
Right.
give you granular details on how the family sizes have changed in India and how family size and household income has changed. Why overgeneralizing whole Indian per capita income into $2,000 or $2,500 and calling it as an inflection point is a useless data. But instead, why distinguish how many Indians are about $10,000 per capita? How many are between 2,000 to 5,000? Actually, 60% of India is below $700 now, right? So each one's consumption patterns are different, and which is what we had focused, and that's why we call this one as Breakout 20, which invests only in companies where most of the demand comes from the richest 20 so far, but now they are expected to grow faster, not because their consumers are consuming more, but because more consumers are consuming it. Which means when you see crowd in airport, it's not that people are flying more; it's more people flying. When you
Absolutely.
see crowd in restaurant, it's not that people are eating out more; it's more people eating out. Now,
Right.
that more, who are they and what do they consume is the answer to which this one. So this is extremely thematic. So thematic themes are not suitable to all investors, but
True.
to those investors who understand that theme, it suits perfectly.
Absolutely.
Yes.
Well, Mr. Maran, actually, it's always, in fact, listening to you, we get so engrossed that, we have actually lost count of time. And in fact, there are so many more questions to ask you. But unfortunately, because of the, limitation of time, we'll actually, we'll have to, in fact, skip the question and answer session also, because, we have already jumped beyond 1 hour, and it's been such a wonderful, informative session. I'm sure this Diwali, a lot of investors will have a lot of takeaways who will listen to you. Be it, do not focus on market capitalization, focus on businesses. Okay, see who is buying what. Okay, as well as, do not look at too much of, like what you told, the global economic data. Instead of that, look at the, what's happening around you, in fact. And so many more things which, if we can, if we discuss, I think, there will be so much more information which we will get. But so, Mr. Maran, thank you very much. And it's been wonderful as usual talking to you, and understanding the differential perspectives which you give around equity investments. uh, Unnati will just will take up from here. Unnati, can you uh, give the closing comments, please? And we can, what we
Yes,
can
sir.
do, yeah, and whatever questions are there, we can actually post it to sir, and we can actually, we can send it across to respective investors, in fact. Yeah, Unnati.
Yes, sir. I think that was a very informative session, sir. Uh, on behalf of Cedrus Wealth Partners, I would like to thank the entire Unifi team for making the time to grace this event, and also to all our viewers for tuning in. We will return next month with another topic. Thank you so much, sir. Once again, wishing you all a very happy Diwali and a prosperous New Year.
Thank you so much.
Thank
Thanks for having us. Thank you. Thanks for the
thank
opportunity.
thank you.